Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Thursday, April the 28th. The year's 2022. Let's talk trading. Master of One, Part 13 with Walmal. This video is for educational purposes only. Your results may differ from mine and from Walmal's. Walmal, we got to pick up from where we left off again. So set your timer for about 14 minutes right now.
Yeah, I'll go and do that. I'll do that right now as I'm talking. I was talking yesterday. Let me, in case some listeners didn't go and see or hear the video from yesterday. Let me go and start from there and give a little bit of a recap. But I was talking about this whole idea of how do you get in and out of trades? When do you make decisions to get in and out of trades? And it got into a discussion about, how do you go and figure out how much are you going to go or willing to risk on a particular trade? It becomes risk management. In other words, when you pull the button or push the button, pull the lever, whatever you want to call it, how much are you actually putting on the line? And started to talk about this whole idea that, most traders, if all of a sudden they get an account size of, a certain amount of money, let's say you get an account size of $5,000, okay? Well, you could technically on a $5,000 account go and trade 10 lots. I mean, probably not a wise thing to do, but you could, with just about any broker, no matter how much leverage they give you. But the thing is, it puts you in a position, puts you behind the eight ball, because as soon as it starts going against you, goes against you, 1 pip. Well, now I'm down $100, goes against you 2 pips. Now it's $200, and it adds up real quick. So probably not a good idea, and you can get yourself into, that improper risk management turns into an emotional problem. Because what happens is you start putting yourself behind the eight ball. It's like, what am I going to do here? What am I going to do there? And so on and so forth. And it just puts you in a bad position. And a long-term trader taught me something many years ago, and that is that you shouldn't risk more money on any particular trade than you're willing to pull out of your pocket right now and burn it in the street. Now, there was kind of a little bit of a, tongue-in-cheek. He said that, and probably a little bit of an exaggeration. But there's some truth to that, because the idea is that you don't want emotion to go and jump into it and cause you to go and, be forced into a situation, not because the trade's not a good trade, or the trade is still in the process of developing, but you don't have enough room because of how much you've risked. And that puts you behind, again, I'll say it again, probably the fourth time in this video, it puts you behind the eight ball. Puts you in a really bad spot, and you sometimes are forced to go and do things. And a lot of times what I like to do is, if I'm willing to go and risk, let's say I'm willing to risk $100 on a trade. This is my out point. This is where I get out. I'm willing to risk $100. A lot of times they'll say, you know what? I'm not going to risk $100. I'm going to risk, $30. And you say, well, that's not going to work out too well for you, because then you can't make as much. You're right. On that one particular trade, I can't make as much. But at the same time, I'm never at risk of going and getting into that position of, being forced out of a trade because of emotion, because the trade is being developed. I'm never at that position. So I think that's a very, very important, lesson for all of us as traders to go and learn, is that, manage that risk. And if you manage that risk, you can get to the other side, and you'll probably do better off. And so that's kind of a recap what I was saying yesterday. But now to bring it to the next step, where I got cut off on the length of the video. And that is that, okay, I was talking about this idea of gunpowder. You don't go and use all of your gunpowder on one trade, and that's that risk management that I was just talking about. But if I go in with, let's say, 1/3 of what I'm willing to lose on a particular trade, what that means is that if the trade goes in my direction, I've got room that I can go and actually put another trade on. That's pretty cool. I can stack on my trade, and hopefully the trade goes and continues going in my direction, and I can do it again. And now because if it goes up, and now if it continues going up, I can do it even a fourth time. All because of the fact that I didn't go in the first time, with all of it. Now, if I was to go in with everything that I can, sure, I can stack on once again with the profit, but I have to wait a much longer period of time to stack in. And the reason why is because I need room for it to have gone up a certain amount so that if it does start going against me, I don't get to the point where I've now lost everything, more than I'm willing to lose on a particular trade. Now, I know.
Well, hold on, Walmal, because I think you're equating risk with position size, and you might be confusing somebody.
Yeah, probably. And it's part of the reason is because I look at things maybe a little bit differently than some other folks do, and the reason why is because at the end of the day, the only thing that matters to me is how much money I made or how much money did I lose. That's the only thing that matters to me. And
actually, there is one other thing, and that's whether or not you followed your trading plan.
Well, absolutely. Absolutely. Well, the thing is, following the trading plan is what gets you to go and do that. That's the strategy, technique, tactic, whatever, all those different components. But the trading plan is what allows you to do it. But what I'm trying to say is that what I care about more than anything else, okay, what really is important to me is when I walk away, did I go and follow my trading plan so that I went and stayed within, the confines of a river, meaning that I'm going in the direction I'm supposed to be going in. I'm making money, or if I had a bad day. We all have bad days. And did I stay within the confines of the river and go outside the bounds of that river, and now I've lost more than I was willing to lose on a particular day? And that's what's important to me. And that's what keeps me, hopefully, as they say, with the sunny side up, and not in a position where I'm, having some trouble.
Mm-hmm.
So now, getting back to what I was saying in terms of, if you get into a position where you've maxed out how much you're willing to go and risk on a particular trade, even if the trade is going in your direction, okay, you need to go and wait for that trade to go a substantial distance before you can stack on. And the reason why is because if you're going to stack on immediately, you are at risk of putting yourself in a position where you can lose more than you're willing to go and lose, because if it starts coming against you, let's say you're up 2 pips or 3 pips, something like that, and you stack on, but you went in full bore. Okay, and let's say your risk management says that you're only allowed to lose, I want to say 7 pips. Okay, what happens if you're up 2 or 3 pips and you jump in? Okay, again, full bore, and now all it does is it goes down 5 pips. It just takes a breath back and goes down 5 pips. Well, guess what? You're now out of both trades. Immediately, you're out of both trades with the max that you're willing to go and lose. Okay, take it a different way. What if you go in with only 1/3 of what you're willing to do, of what you're willing to lose? You go in and it's up 2 or 3 pips, and you stack on. And let's say it goes against you the 5 pips again. You're still with it. If you figure that out, you're down in that first trade, you're down probably 3 pips, 2 or 3 pips. That second trade, you're down 5 pips. And let's say your max to get out would have been, your risk says that you're allowed to go and take a 10-pip risk. Well, you're still in the trade. You haven't risked everything. And now it turns around and goes in your direction. Okay? And now you're able to you're able to go and ride it back up. Whereas the first scenario, you're just immediately out. You snapped out. And that's how I trade things, because I just like the idea that, hey, I can make a lot more money going and doing it that way. And here's, I think, part of the reason why is because what that trade is doing, when I'm getting in there, what that trade is really doing for me is it's proving to me that it actually is doing with whatever my method is. My method says, let's say we're trading inside bars, okay, and it breaks the top of the inside bar. Okay, and I go up 2 or 3 pips, from it. Okay, that's great. Okay, it looks like it's really starting to pan out. Looks like, okay, I got enough range in this hour. It's going to continue going. I got enough range in the day. All these things are confluences, saying that, hey, this is probably a good trade. Yeah, everything's going my way. Okay, I go and jump in again. And when you add all those reasons up, by the time I get, to a certain point, I'm probably at full bore because I've added in, 1, 2, 3 times, and now I'm at full bore, or maybe even more than that. Whereas the other way, it's sort of like if I'm at full bore, there's a much higher. I mean, the market if you just look at private price movement right now, going up and down, sometimes that movement up and down can go and take you out of trade relatively quickly. Whereas if you are in a much lower level, it doesn't take you out because remember, and I say this all the time, pips don't mean, don't mean pip to me. What matters to me is dollars. So my risk management is all based on dollars, and I've been talking pips today because I know most people do it based on pips. I don't. I do it based on dollars. Was that clear, or did I confuse even more people?
Oh, I'm not sure. I guess they can let us know in the comment. But it is coming up. Tomorrow's the last day of the month, so this is part 13 here, and we got about 3 minutes or so left. So out of all the things we talked about, master of one, what do you think's the first thing a struggling trader should master?
Their trading plan. In all seriousness, their trading plan. Because the thing is, the number one thing that's so important with trading is being disciplined. You should know your trading plan so well that you don't need to even have it in front of you, but have it in front of you anyway, so that you can always refer back to it. It's, people have probably noticed that I've been doing a lot of analogies of being a pilot, and one of the things, and part of the reason why is because I've always wanted to go and get my pilot's license. I've always wanted to do that, so I've been doing a lot of research lately about what it would cost, how to do it, so on and so forth. One of the things I've picked up already by going on a couple of flights with some people is that these guys, this one guy that I went up with not too long ago, he's a pilot for Delta Airlines. And prior to that, he did 20 years in the military as a fighter pilot, and now he's in his 15th year at Delta. So he's got 35 years of flying, and at the same time, every single day, he knows exactly what he has to do to get that plane off the ground and into the air, and how to get the plane out of the air and back onto the ground. But it's amazing to me that he's got a checklist, and they put his checklist on on an iPad, and that checklist has everything he needs to go through, and he still goes through that checklist. Yeah. He's got a flight plan. We have trading plans, and that's what we have to do: develop our flight plan, so to speak, and follow it. And don't be so smug as not to follow it, and don't be so smug to think it's better not to just go and do it and wing it.
Yeah. Well, for me, I would say the most thing, if you're going to master, is you have to master your brain, because you can have the best trading plan that includes the best entries, the best money management, the best risk management, but if you go on tilt, all that goes out the window. So you definitely have to master yourself, because it's funny, making these videos and watching, price move and everything. It really is one of those things where, people say it's random. People say, no, it's not. None of that stuff matters. And what really matters is once you get in a trade, what you do next. It's like, if the market smiles upon you and gives you a chance to take profit, you take the profit. If it's going against you, you cut your loss, and that's it,
Absolutely.
Because, that just kind of really gets into, what I always end the videos with. It's not what you trade, it's how you trade it. And, I think, a good training tool would be, is sitting down at the at a screen and let somebody else click the mouse to enter. Now you have to do what you need to do to manage that trade. So, we're just about out of time. So I'm going to repeat it, fellow traders. Next time you're at your trading terminal, always remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.